Now, here's the thing, is that when we talk about finding edge, right, finding trades that have an edge, what we talked about up until now is just edge from the options trading perspective, right? How do you find credit spreads where the amount of risk that you're taking on is relatively small to the amount of risk that you are potentially making on a specific trade? So that's the edge that you can get on the options trading side. But that doesn't talk about the edge that you can get on the technical side from a timing perspective. Because if you look at kind of a stock that's in a trend, right? So in the previous example, we saw a stock that was starting to make higher highs and higher lows, trending higher. So how do you use that to your advantage? Well, you when the stock is trending higher, you can sell credit spreads at any point in this trend, and largely you will be profitable regardless of the timing of your trade. However, that doesn't mean that the timing of every trade is the same. So, for example, if let's say you were to sell a credit spread when the stock was right here, well, would you have made money on that credit spread? The answer is likely yes, right? But the problem is that you would have had to sit through a few weeks of chop. You would have potentially gotten stopped out, but likely you might have just held this trade and had to suffer through a few weeks of worth of pain before the trade turned profitable. Same thing here. If let's say you were to enter the trade right here on this bar on the high, right? Will you be profitable? Yes, but you would have had to sit through a week worth of losses eventually to see your trade to turn back into a positive and turn yourself into a profitable trade. If you got into the trade here, would you have been profitable? Yes, but you would have had to sit through some pain, eventually probably a couple of weeks or 3 weeks worth of pain before you get to a point where you can take profits on the specific trade. So as you can see, the forgiving nature of this specific strategy is really incredible because as long as you identify a directional view, you don't have to time the trade. You can get into the trade and expect that over the long run, you will be profitable with this type of strategy. However, when you can time the trades correctly, meaning when you identified a bullish setup and you wait for pullbacks of that specific setup, what you can do is enter these trades at a much more optimal time. If you were to enter the trades at these pullbacks, what you would have been able to do is basically take profits within just a few trading sessions. So instead of having to sit through pain, you would have been able to take profits in maybe a week or two at most and be able to reach near your maximum profit in just a short amount of time. And out of these trades, you would have had maybe one or two trades that ended up being losers, where long term the trade ended up turning south. But overall, if you were able to catch a long term trend and you wait for the kind of the optimal bullish entries, which are pullbacks within a bullish trend or rallies within a bearish trend, right? So if you've identified that a stock is starting to make lower lows and lower highs, what you want to do is you want to wait for rallies in that specific trend to enter that bearish trade. Because if you wait, then you can be profitable within a very short period of time versus having to sit through some pain or sit through a few weeks of the trade before you're able to turn a profit. And that's really kind of where, if you want to generate consistent weekly income, you want to be very selective with your trades and only trade the best possible setups from both a technical perspective and well as from an options perspective in order to gain that edge so that you can get into a trade and get out within roughly a week's time, even though you're selling a 45-day option.